Back in 2022, JP Morgan traders were convicted of spoofing the markets and attempting market manipulation. This revelation raised many questions, the most popular being, are the markets really manipulated? The simple answer should be a yes, since both Smith and Nowak were found guilty, but it's not that simple. You will soon find out that manipulation is everywhere, and the most shocking part, it can be legal. Stay tuned as we break down how and why the markets are manipulated, the role of the 1934 US Gold Act, the rise in gold price, and what to do as an investor. Let's start with the history of gold in America. In the United States of America, gold shares a complicated and turbulent history. No matter how much you talk about the financial history of the US, gold has always been a profound part of the story. A lot has happened. Hundreds of ships have crossed the Atlantic, while entire civilizations have been conquered, all in the name of gold. And if you didn't know, gold has always been the defining factor of the value of currency. Written in the mercurial 20th century and beyond is the influence of gold in America's history, taking the nation from a chaotic to a prosperous new century. At the time, the Americans saw two world wars, a devastating market crash, and the rise and fall of fascist and communist governments, while transforming into the richest country in the history of the world, courtesy of gold's influence. Fast forward to the 21st century, a time of economic and international insecurity, when national debt and deficits swell to unprecedented heights and countries around the world descend into economic despair. But through it all, gold maintained its value despite market devastation, trillions in government spending, and a precarious international theater. Today, the United States is a prolific producer of gold, with an approximated estimate of 173 tons of gold produced according to a recent report. America is currently the fifth leading producer of gold worldwide after China, Russia, Australia, and Canada. Now that you know how important gold is to the world economy, should it still be a concern why central banks are hoarding gold? The truth is, if you know the increase in the rate of buying, you definitely find it shocking. Central banks are underpinning what some analysts predict may be a new bull run on gold. Economic uncertainty and global realignment are fueling the demand for the precious metal. Gold is once again proving itself to be the safe haven asset of choice by central banks. They are accumulating gold reserves at a rate last seen over 50 years ago. Because Russia invaded Ukraine and the subsequent sanctions, the gold rush was triggered. But soaring interest rates and a strong dollar saw many leave gold for interest-bearing securities. Central banks more than picked up the slack. Many took advantage of falling prices to shore up their reserves. The banks accounted 34% of total demand in the third quarter of 2022. During that time, central banks bought a record 400 tons of gold worth approximately $20 billion. Demand in the first 9 months of 2022 was up 18% year over year and back to pre-pandemic levels. Again, in 2023, central banks gobbled up gold. According to the World Gold Council, the central bank's net gold purchases totaled 1,037 tons. It was the second straight year central banks added more than 1,000 tons of gold to their total reserves. Central banks now hold an estimated 36,700 tons of gold as the global scramble for Federal Reserve note alternatives continues. Generally, we have two categories of banks. Banks from advanced economies and those from emerging markets or developing economies, called EMDE. Both hold gold as a reserve asset, with more than 80% holding gold as part of their international reserves. Central banks are holding more gold in response to both economic and geopolitical uncertainty. While advanced economy banks and EMDE banks share reasons for acquiring gold, note that they also have their own distinct motives. Both banks have traditional reasons to hold the yellow metal. One, gold is a historical legacy asset position, which means they've always just had it. Two, gold is a proven long-term store of value and an effective portfolio diversifier. Portfolio value declined as central banks around the world raised interest rates to combat inflation. They purchased gold to preserve that value. And when the Fed's tightening ultimately relents, when inflation levels off and the growth costs become too high, the banks will be positioned to reap substantial paper profits. The central banks also turn to gold as a hedge against persistent inflation and the effects of the recession. They are keenly aware of the impending global financial crisis, and many rely on gold to mitigate its potential effects on their bottom line. Now, non-traditional reasons are also powering to move to buy gold, especially for EMDEs, emerging markets and developing economies banks. Everyone knows how much the Russian invasion of Ukraine shook the global financial order, with the Russian sanctions waking up non-Western nations to the vulnerability of their US dollar reserves. According to a World Gold Council survey, 42% of banks expect the number of US dollars held in reserve to drop as Russia and China was seen buying gold aggressively, perhaps to help protect against foreign seizure. EMD banks are seeking higher reserves of gold as a buffer against any payment crisis that may erupt from current or future sanctions. Faced with additional challenges, EMD banks have been the main engine of central bank gold buying for the past several years. They are put at a greater risk by shifts in global economic power and the growing split between, on one side, the US and the West, and on the other, Russia and China. EMD banks tend to not have the same faith in US dollar reserves as Western banks. They are often way more aggressive in gold purchases than their counterparts. These central banks often rely on gold to insulate their less solid economies from the threats posed by a global financial crisis. So where US, European, and Asian banks tend to see gold as a historical legacy asset, EMD banks tend to see it as a strategic asset. So if you think central banks have bought enough, they are still going to buy more this year. But does this have anything to do with the market manipulation? Many argue that central banks have the motive and means to manipulate gold prices, pointing to sudden, unexplained market movements or the curious timing of gold sales by central banks. But before we go deeper, let's understand the real meaning of gold market manipulation, also called gold price manipulation. Broadly, it is defined as a purposeful effort to control gold prices. Many gold investors believe that the gold market is systemically manipulated. But is it? If yes, by whom? The truth is, price manipulation exists in financial markets as traders try to influence the markets. It may be responsible for some short-term aberrations in asset prices, including the price of gold. However, there is another, more specific definition. According to the US Securities and Exchange Commission, the SEC, manipulation is intentional conduct designed to deceive investors by controlling or artificially affecting the market for a security. This includes rigging quotes, prices, or trades to create a false or deceptive picture of the demand for a security. It is widely believed within the gold investing community that gold prices are manipulated, generally downwards, in other words, as price suppression. If you have the chance to converse with different gold investors, most will speak of their belief of a possible systemic manipulation in the gold market. Some of them blame the central banks, other big banks, and the use of derivatives and high-frequency trading for the declines in the price of gold. Somehow, at first glance, this theory makes sense, especially considering that the price of gold was fixed for decades by governments, while a few financial institutions have already been fined and some individuals sued for influencing or manipulating gold prices. But how are those institutions or people supposed to manipulate the price of gold? Many people have pointed fingers at bullion banks for naked short selling of gold to drive down the price. Confused? To understand what naked short selling means, you need to understand gold short selling, which is the sale of bullion that is not currently owned by the seller and the subsequent repurchase of the metal. How do they do it? They usually borrow. The idea is to take advantage of the price decline as it enables you to repurchase gold at a lower price. Now, when we say short selling is naked, it means gold short selling occurred without borrowing it, or at least ensuring that the precious metal can be borrowed. You know what can happen? The short seller can sometimes fail to deliver gold to the buyer. The problem with this is that it leaves the world with about 80% of the gold it thinks it owns that doesn't even exist in the first place. It's just all on paper, no metal to show for it. The impact of naked shorts is thus controversial. It is popularly believed that the Fed uses bullion banks as its agents to put naked gold shorts on COMEX to drive down the price of gold. It protects US dollar's value and enables banks to repurchase gold at lower prices. But can we say big banks like JP Morgan Chase constantly manipulate the gold price? If banks had massive positions in the gold market, they would have to buy large numbers of future contracts to cover their position and buy the physical metal to deliver it or roll their positions, buying expiring contracts and selling the next one out. In all cases, the short-term impact of selling the futures contract would be reversed as banks would have to unwind their positions. Thus, the practice of naked gold short selling, existing or not, cannot explain the long-term bear market in gold. There's, however, no denying the short-term price anomalies, such as the 2021 case of traders from Dutch Bank and Merrill Lynch. This is about short-term. What about the long-term? Let's see together the long-term movement of gold. If we need to tackle this issue with reports from studies, we can just agree that there's no evidence of gold price suppression. If you take the time to check the long-term behavior of gold prices, like this chart showing the movement of gold from 1976 to 2021, you'd see clear cyclical patterns, not a permanent downward trend or even a flat line. Therefore, from the long-term perspective, and especially looking at the 2000s, it is hard to understand the accusation of manipulation in the gold market. However, a fact stands out. While no one or body can manipulate the gold price and go scot-free, the US government can manipulate the gold price and it's totally legal. How? That's where the 1934 US Gold Act comes in. Simply put, the rule that changed everything. On January 30th, 1934, President FDR signed the Gold Reserve Act aimed at helping to boost the flagging US economy. The Gold Reserve Act of 1934 prohibited private ownership of monetary gold and allowed the government to raise the price of gold, control the value of the dollar, and put more money into circulation. Among the law's many directives, the government's holding of the precious metal was transferred from the Federal Reserve to the US Department of the Treasury, diminishing the central bank's role in maintaining gold coins and bullion. The act was the pinnacle of Roosevelt's gold program, specifically policy measures that seized gold and abandoned the gold standard as a means of controlling the value of the dollar. It all started with the Great Depression, which began with the stock market crash of October 1929. Millions of Americans became unemployed, credit was difficult to come by, and the economy collapsed. A year before, Roosevelt was elected president in the hopes that he would lead the country onto a path of economic recovery and prosperity. And did he? One of the biggest challenges to the US economy was the lack of credit being made available to many Americans. Without loans, people were unable to spend for their everyday livelihoods, and in turn, the lack of spending and money in circulation kept the economy from growing. During Roosevelt's first year, he enforced the seizure of gold coins and certificates that were in the private hands of Americans and businesses. The US then relied on the gold standard, which backed the dollar and allowed the dollar to be converted into gold at a fixed rate. That way, the Federal Reserve had more than enough gold reserves to sufficiently support the dollar. The Gold Standard Act of 1900 replaced silver with gold as the standard for the US dollar, setting the price at which the government bought a troy ounce of gold at $20.67. But after the 1934 Act was signed, there was an increase in the purchase price of gold to $35 an ounce, which effectively devalued the dollar by 59% and ended the fixed price of $20.67 an ounce set at the end of the 19th century. The gold standard constricted the US government from expanding the nation's money supply because dollars were fixed to the supply of gold. So its suspension gave the government flexibility to increase the money supply. By leaving the gold standard, the government was also able to manipulate the country's currency via a devaluation. The act created the Exchange Stabilization Fund in the Treasury Department and authorized the Exchange Stabilization Fund to trade in gold and related items on behalf of the Treasury Department. The Exchange Stabilization Fund does not only have the authority to intervene in the gold market, but also to intervene on behalf of the US government on any market in the world, not only the US markets. Therefore, even if the US government has decided to manipulate the price of gold secretly to deceive investors in other countries, it is very much legal. One more question. Who gets threatened by the rise in gold price? Most likely, the gold demand will remain high, and that is good news for individual investors. For those with retirement funds, now may be a good time to move assets into gold. Central banks are providing long-term price support. In addition, some analysts see precious metals entering Goldilocks conditions. Smaller interest rate hikes could combine with lingering elevated inflation to create the conditions for a gold bull market with record highs. Individual investors could benefit by following the lead of central banks. Buying gold can help them protect their wealth from inflation, recession, market volatility, and global uncertainty. If anyone is threatened by the rise in price, it's definitely the government. And here's why. Gold is a currency, just like the dollar, euro, and pound. And as a currency, it competes with government currencies, something the government does not like to see. This is because if people tend to move towards the currency that is doing well, gold is not that easily controlled. And if people should start using gold as money instead of dollars, the government can lose control over the economy. This is why whatever happens to gold is very important to the government. When there's troubles like this, the government can count on bullion banks to help them hit the market with a lot of imaginary gold. And if they want to devalue that, they make the price of gold go higher, thereby devaluing the dollar for that period. After all said, you may choose to stay on any side of the story. One, there is no concrete evidence that the market is manipulated. On the other side, the US government has laws backing it to manipulate the price of gold. As an investor, you shouldn't let go of your gold because of suspicions. The market won't stay in place forever. You can also decide to follow the move of central banks and buy gold the way they are. Now, what do you think about the gold market? Do you think the US government used this 1934 Gold Act to the advantage of the public? Let us know in the comment section.